Have you worked your whole life, saved every penny you could in that IRA, and now you're finally ready to enjoy it, only to realize you have a silent partner sitting at the table waiting for their cut? It's a frightening thought, isn't it? You look at that account balance and you see 6 figures, maybe 7, and you think, that's my nest egg. But is it? Or is a huge chunk of that money actually owed to Uncle Sam? Listen to me, because this is where so many retirees get blindsided. You've done the hard work of saving, but if you don't understand the taxation of your withdrawals, you are going to leave yourself vulnerable at a time in your life when you cannot afford to make mistakes. We are talking about your security. We are talking about your peace of mind. Most of you have what's known as a traditional IRA. You got a tax break when you put the money in, which felt great at the time, right? But now comes the tax-deferred reckoning. Every single dollar you take out of a traditional IRA is taxed as ordinary income. That is a mistake I see people make all the time. They think it's taxed at the lower capital gains rate like a stock sale. No! It is taxed just like the salary you used to earn. If you are in the 22% or 24% tax bracket, Uncle Sam is taking nearly a quarter of your withdrawal before you even get to spend it on groceries or travel. And here is the fear that should be keeping you awake if you aren't prepared, the tax bomb. If you wait until you are forced to take money out, what we call required minimum distributions or RMDs, and you have a large balance, those forced withdrawals could push you into a much higher tax bracket than you ever anticipated. It can even trigger something called IRMAA, which increases your Medicare premiums. You think you're taking out money for a vacation, and suddenly your healthcare costs skyrocket and your Social Security starts getting taxed more heavily. It's a domino effect that can wreck a retirement plan in a single year. So, what do? You have to be proactive. You cannot just sit back and wait for the IRS to tell you what you owe. One of the most powerful moves you can make is considering a Roth IRA conversion while your income might be lower in those early retirement years. Yes, you pay the taxes now, but then that money grows tax-free and comes out tax-free forever. Imagine the freedom of looking at an account and knowing every single cent belongs to you, not the government. If you are already over age 70 and a half and you want to give to charity, do not take the money out, put it in your bank, and then write a check. That's a huge mistake. Use a Qualified Charitable Distribution or QCD. You send the money directly from your IRA to the charity. It counts toward your RMD, but it never shows up as taxable income on your return. It's a brilliant way to do good and keep your taxable income lower. You must also be smart about the order of your withdrawals. Don't just drain one account because it's easy. You need to balance your withdrawals from taxable, tax-deferred, and tax-free accounts to keep your adjusted gross income in a sweet spot. This isn't just about math, it's about protecting your future. The goal here is for you to be in control. I don't want you to be afraid of your mailbox because you're worried about a tax form. I want you to stand in your truth and know exactly what your retirement costs. Look at your tax bracket today. Look at your projected RMDs. If you don't know those numbers, you don't have a plan, you have a prayer. And a prayer is not a financial strategy. Take the steps now to manage these withdrawals so you can keep more of what you worked so hard to save. You deserve to be powerful with your money, especially now. With that said, thanks for watching and until next time.